So Nvidia just released their earnings a few days ago and they beat revenue and earnings. However, even though they beat their revenue and earnings expectations, we see that the stock is down about 7%. So we're going to talk about what the earnings release was and why potentially that stock is down, even though they beat their earnings. So let's get into it. So they had 68 cents per share, but they were expected to be at 64. So they beat that. 30 billion in revenue. They were expected to be at 28.7 billion. So pretty solid earnings release, beating earnings and revenue expectations. Also, and some more good news, Nvidia announced a $50 billion stock buyback. So we know we like companies when they take that extra cash flow and they buy stock. They take shares off the table, increasing the value of the remaining shares. The last year they announced a $25 billion stock buyback. This year they doubled it. So over the next year or so, they're going to be buying back $50 billion worth of stock. This is a great way for a company to give value back to the shareholder. So we love to see that. So with that being said, let's look at the stock price over the past few months. And we see that we had some dips here, but after the rebound in the earnings release, this is what has some people concerned. This decrease right here of about 7% over the past 5 days. So we see this decrease here, 7.73% down. So let's get into some revenue trends for the company. So looking at revenue trends, we see that the data center is driving the growth, the data center revenue. 3.8 billion all the way to 26.2 billion in a little bit over a year and a half is amazing growth in that area. We see that the gaming, professional visualization, and auto also growing, but not as much as the data center growth. The data center revenue is exploding, and that's wonderful. But I want you to always remember, when you're buying a stock, you're buying the future cash flows of the company. We may buy because we like this trend, but if you buy right now, you're not buying this growth. You're buying the future growth. So you have to have confidence that the company is going to continue this growth in the future. So going to another thing about the revenues, we want to be knowledgeable about the revenue. So one of the things that you always have to look out for are revenue concentrations. That means any customer that makes up more than 10% of the company's revenue. Looking at Nvidia, we see they have 4 companies that make up over 10% individually, about 46% collectively. So people speculate that these companies are Microsoft, Amazon, Tesla, and Meta. So these, of course, these are great customers to have, and people who actually need the most cutting edge technology when it comes to their AI, and with huge AI initiatives. So this is a good thing to have them as customers, but you got to understand the way the revenues are going right now. If any one of these companies decides to decrease their revenues, let's say 5%, that's going to be about 4 billion in revenue that's gone just off of one company decreasing their capital expenditures when it comes to AI. So though that may not be likely to happen with the trends going on in AI, just want you to know that it's possible that one of these people can decide to decrease their capital expenditures or potentially change customers when it comes to the AI chips. Probably not likely as well right now, as Nvidia doesn't have many competitors in that space. However, just want you to be aware that they do have that revenue concentration, which does present a risk. So looking at the revenue trends now, or the business segments, I wanted to point out something. Right now, data centers, that segment is 78% of the business. If you ever want to know what type of business you're looking at, look at the revenue sources. 78% is coming from data centers, 17% is coming from gaming. Now, I want you to, for context, look at this 5 years ago. 5 years ago, this company was 27% data centers and 51% gaming. So in 5 years, they pretty much changed the landscape of the business and the direction as far as serving data centers. The data center sector is growing, or the industry is growing very fast. And with Nvidia continuing to change their technology and improve it, they're going to have lots of customers looking to upgrade and build out more data centers. So that's just awesome for them. So right now, looking at revenues, they are at 58% over the past 12 months. So right now they're trending at 58% for the first 2 quarters of their fiscal year. They have announced that Q3 is not going to be as good as previous quarters. So there's 125% growth from they had in their fiscal year 24, not happening this year, or not likely to happen. And moving forward, they don't even expect to have this 58% growth trend. So that's going to come down some. We'll look at analyst estimates in a minute to see where people are saying this revenue is going to end up. So we see this revenue trend is still pretty solid, with only one bad year here, or maybe 2 bad years, you would say. 2020 at -6% and 23 only growing at 0.2%. Other than that, they more than made up for it in the fiscal year 24 with 125% revenue growth. Solid. So I want you to see that trend and remember future cash flows, future growth of the company. We see the past growth for reference, but we want to look at the future growth. The past 5 years, they've been growing at about 59% per year. Are they going to continue that growth, or is it going to decrease? Analysts are saying that they're kind of estimating a decrease in revenues, and we will see why in a minute. So now, why did the stock come down even though earnings were positive? They beat earnings. 2 reasons. One thing you have to understand, we'll look at the holders. Institutional ownership is about 66.9, about 67% of the shares are owned by institutions. And we know that the institutions are the big movers of the stocks. It's not the retail investors like us, it's the institutions. It's the Vanguards, the BlackRocks, the State Streets, the JP Morgans. These are the companies, Goldman and Sachs. These are the companies that are actually going to be moving the market, because even though we may buy a lot of shares collectively, these people are trading billions of dollars at a time, millions of shares at a time, in and out, depending on what's going on. So you and me, we see that they beat earnings, but however, these analysts at these institutions that are making these decisions, they may have a different expectations than the ones that are publicized. So we may see that, okay, 64 cents per share, they did 68. Vanguard could have expected 72 cents per share, even though what's publicized is 64 cents. Based on their research, their knowledge, and their conversations with management of the company, they can come up with their own estimates. And even though it beats a public estimate, it doesn't beat their individual estimates that they have within their system. So they may choose to trade or sell stocks because it didn't meet their expectations. So that's one thing. The whisper earnings, the earnings that are going on in Wall Street behind closed doors where we don't know what's going on, what the conversation is, they may not be happy with the earnings where we may see, hey, why aren't you happy? They beat earnings expectations. So that's one reason. The second reason is the Q3 forecast is not looking as good as their previous quarters of the year. And that's because their technology, they're working on a new technology called Blackwell. It's a new platform that is apparently going to revolutionize many industries, or AI specifically. This is their new AI super chip that they are designing and having some delays. So some shipments are being pushed. They expect to be shipping in Q4 this year and through, or starting in Q1 of the next fiscal year. So let's see, it's 6 industries that this is going to impact. We see data processing, engineering simulation, electronic design automation, computer aided drug design, quantum computing, and generative AI. As they say, all emerging industry opportunities. So again, this is a press release directly from Nvidia. So you have to be careful when you're reading a press release from a company. It's basically an advertisement. It's good information, but you have to take it with a grain of salt. You can't eat up every word that they're pushing to advertise their growth and the future of the company. So this is public relations, if you will. So we see that the Blackwell technology is coming out. They have high hopes for it, but you want to be careful because it happens where businesses like Nvidia and other tech companies, they will make an announcement. They will project all this growth, put out good news. People may get excited about it, but they might end up scrapping the technology due to some issues, or maybe it's just not feasible. So we've seen that with other tech companies, and specifically companies that are designing chips. Not sure if this is going to be a major issue for them or not. However, we know that they're working on a new technology and they're having some delays. And that's another reason why some of these institutions might have sold some of their or unloaded some stocks. So that's two reasons. We don't know what the actual earnings that the institutions have. And also Q3, we don't know what people are really thinking about the future of this Blackwell technology. Some people might have lost faith already. We don't know. So those are reasons why you have to be careful when it comes to trading earnings. You really, even though they may miss or they may beat, you don't understand what's going on behind the scenes. So always be careful when you're in that situation of thinking about buying or trading stocks around the earnings. So let's get to a valuation. So I want to show you something about this stock. Now, their analysts are saying that they're going to grow next year at about 40.8%. For the next 5 years, they're projecting a 47% growth rate. So I will say this number has decreased over the past week. It was in the 50s, can't remember exactly the exact number, but it wasn't 50 something percent. Now they're saying 47%. So we want to be conservative and come up with our own estimate. So typically what I would do throughout my research, find what I think the growth is going to be, or look at analyst estimates and probably discount that just for safety. So for safety purposes, I went with 42% growth for the next 5 years. And I ended up at an intrinsic value of about 98.97 cents per share. Now, I am a conservative value investor, and you have to understand something. When you are looking at great tech companies, great stocks like Nvidia is, you can expect to pay a premium. So again, I know I'm going to pay more for Louis Vuitton than I am going to pay for a Coach. Is Nvidia Louis? Probably. So even though I like my discounts, I understand it's probably not likely that I'm going to get this stock at that price. Now, one thing you have to understand, also, if you're doing a discount cash flow, play around with the estimates. If I say, hey, they are going to grow at 47%, let's say those analysts are spot on. When you look at that, the stock is pretty much fairly valued at $119, just barely over this little intrinsic value of $116, only a $3 difference. So if they do grow at 47% as they're projected, that's a good price to buy at $119. But again, I like to be conservative and I also like a discount. So I am going to assume 42% growth just for safety. And I say $98 is the intrinsic value. Again, I don't expect it to get to that level unless there's some major recession or movement of that stock for some reason. But of course, I like that price. So keep that in mind as you, excuse me, don't say keep that in mind. What am I gonna say? Nope. Also, when you're thinking about this value, you have to understand the revenue growth in conjunction with the share buybacks. They did announce another $50 billion, and it looks like that trend is either going to hold or they'll maybe even accelerate it in the future. So I have to keep in mind that as they buy back shares, these shares that I'm looking at now become more valuable. So keep that in mind when you're thinking about what the true value of a company is. Look at all the factors, all the threats to the business, and make sure you include that in your analysis. So I hope you found this video helpful. Consider liking and subscribing, and in the comments, let me know what you think and what other stocks you would like for me to review. I hope to see you in the next video.